But the real core, fundamental, critical information is in the actual volume at price currently. How much is really trading at these prices, and what's the price doing as a result of that?
Good day, traders, and welcome to episode 2 of the Sound Trader Interviews. You can find this podcast episode at pricesquawk.com/John-Grady. That's right, we are excited to welcome John Grady from No BS DayTrading to the podcast. John is a veteran order book day trader. He has experience on multiple prop trading desks where he first learned his art and was a major influence on my own trading by showing the benefits of watching the prints in the order book. We started out chatting about the difficulty of letting go of old market beliefs.
I mean, it's you can't really turn yourself into a blank slate as much as sometimes you'd like to do that with a person. You know, you want to say, look, man, just for just a minute, just forget what you think you might know, you know, and just kind of take this idea and concept and run with it. And then if you run with it, kind of like a scientist, you know, the whole thing about science is, which is why I have admiration for them, is they'll admit, like, look, either I'm right and you're wrong, or you're right and I'm wrong, or we're both wrong. And we need to figure out what the right answer is. So it's pretty hard if you've been conditioned to believe, in certain, whatever, indicators or theories or whatnot when it comes to the trading realm. I won't get too far off topic from trading, but, yeah. And I was that way when I started as well. You know, when I first went in, to the prop firm, I was very biased, having spent several years on my own as a younger guy, trading off of head and shoulders, you know, and support and resistance, and not really understanding what was going on, but I thought I understood what was happening, you know. So it took a little bit of humility, really, is to be quite honest, what it was. It was humility and being a little humble and recognizing that I might think I know something, but I haven't made any money. So obviously I don't really know something. So let me pay attention to what this guy over here is doing, because he's actually making real money. And that was a turning point for me.
When did you first start in the prop shop? How many years ago was that?
That was not quite 10 years ago. It was about 9 years ago. So I had been trading. I actually made my first trade right out of high school. I mean, I had a few $1,000s that I was able to put into a stock account. So I spent several years between my late teens and early 20s, trying various methods of trading, everything from stocks and options and all the technical analysis type stuff. And then, I actually worked for 3 different equity prop firms before moving to Chicago to work for a futures firm. And those equity firms weren't really equity prop firms. They were, 2 of them were brokerages that had prop desks that didn't last very long. And because they didn't really know how to teach anybody, it was right around the NASDAQ bust. So I kind of, you know, it went back to what I think you were part of that conversation the other night on the Scalpers Anonymous room, when I was talking about circumstance, sort of where you are and what happens to be going on. So when I came into my first prop shop, it was as the NASDAQ was turning to go down, basically. And the guys that were in there with us, who were, you know, these supposedly great traders, and some of them were very good traders, but they had made their money in a NASDAQ market where they would just spray a price for 50 cents, literally 50 cents. I mean, try to imagine that, you know, today. So you had these stocks like, and I won't get too far off, but like Amazon, Sienna, and a couple others in that time frame. And you could spray everything in sight for 50 cents, and then the market would run $3 past that in a matter of a minute or two, and then they would just cover, you know, and they could do that all day long. So unfortunately for me and some of my buddies that, or guys that I met at the prop firm, we came in and we had these guys who supposedly were great traders. And what they were is they were great traders in a raging bull NASDAQ market. And so when the market turned around and started to disintegrate, there was a lot of volatility at that time. So it wasn't like a straight down disintegration. I mean, there were ups and downs, but they didn't quite know how to adapt, and they started having major swings, and they were not interested in teaching anybody. So basically had a couple failed experiences at equities firms. Not due to myself, I didn't know much anyway, to be fair, but no one knew anything and no one was teaching us anything. So it was, when I got to Chicago, basically, so that was about 9 years ago. I got to Chicago, and then they were a totally legitimate trading firm, and were backed by guys that had real money and guys that were real traders.
And they treated it more as a skill, I take it, in the derivatives firm.
Yeah, I mean, what it was there were some guys that ran a firm. They still run a firm, actually, in Chicago, and they do a lot of brokerage. They do a lot of clearing for other funds and whatnot. And a couple of the partners of that firm came together and invested some money into a prop shop deal. And so they hired another guy who used to be a floor trader, and he had come off the floor. His deal was he had actually made quite a bit of money on the floor, and then he lost a lot, and he had kind of a cutoff switch. He just walked away from it while he was still up a significant amount of money. So he came on board as the manager, and I give him props. He made some really good hiring decisions. I mean, it seemed random sometimes as to how he picked people, but he ended up picking, some pretty decent guys that turned it around and made them a lot of money. So they viewed it as, and this is why I say this is a good point for anybody who's thinking about joining a prop firm. I discuss this in my material, but you have to understand who's running the firm, what their background is, how much money are they prepared to invest in it. Do they pay any kind of a salary or a draw? And a lot of people are opposed to that. And I understand why. I mean, you don't want to, you bring in a kid and you think, I don't want to pay this kid $2,000 a month for 6 months, and he makes $12,000, and I can tell that he can't turn the corner, or a year or whatever, he makes $24,000, and then he bails on me or something, or he's just not going to get it. I get that, but unfortunately, from the flip side of that coin, you have an individual typically that you don't want that guy going out trying to be a bartender at night and work from 8 p.m. till 4 a.m. and then come in the morning, to trade from 7 a.m. till noon. Because I actually did that. When I was working at not in the Chicago firm, but when I was working at the equities firm, I was in Colorado. I woke up at 6:30 in the morning. I drove to the equity shop. We started trading at 7:30 because it was 2 hours behind. So 9:30 opening on the East Coast, so 7:30 Colorado time. I traded from 7:30 till about 12:30, 1 p.m. Had lunch, got in my car, drove to a job that I had to start at 3 p.m. Worked from 3 p.m. till 11 p.m. Went home. That was a 40-minute ride. Tried to get in bed by midnight, and then woke up at 6:30 a.m. and did it all again the next day. And I did that 5 days a week. I did that 5 days a week for about 3 months. And then they shut down most of that prop division got shut down anyway, cause no one was making money and nobody there could teach anybody how to make money. But anyway, the point being, that makes it so difficult as a guy trying to make it, because guys just give up sometimes. They're like, this is ridiculous, man. I'm eating ramen noodles and hot dogs and I'm killing myself. And I'm going to try to trade, and they're only giving you enough because you're a new trader, so you haven't proven yourself. So even if you're live, they've only given you enough contracts or shares to make $100 on any given day, or $200 on any given day, And so you're working a normal job, and you're like, I made 3 times as much at my normal job today. Why am I bothering going in? Why don't I just save up my money and try and do it on my own? And so I think prop firms do themselves a real disservice by not making the investment and giving a draw or a salary to their traders. And I fully, admit this and attribute a large amount of my success to the fact that the Chicago firm did that. So we were paid a salary. It wasn't much of a salary, but we were paid that a salary that paid the rent, paid the bills, and we could eat, and we didn't have to have second jobs. And so all I had to do was show up every day and focus on trading and not be worried about how I was going to pay the rent. Cause the other side of that is that you get a guy who's struggling for money, and now he's not going to trade well either because he needs to pay his rent next month. And so maybe he has a little bit of size. Maybe he's a 4-lot, 5-lot trader or something like that. And he comes in one day and he just takes shots because he needs to make $3,000. So he makes a bunch of bad trades, and instead of making $3,000, of course he loses $3,000. And then you write him off, and then he has to go on down the road. But in reality, he never would have made those trades if he hadn't been worried about his rent payment.
Well, in the Chicago experience then, how many months were you there? Were you there for years, months?
Yeah, I was there for a year and a half, a little bit more than that. It was without going into much detail, there were some issues with the contract, and there were a lot of politics that came into play. And I was part of the second group that was hired. So they hired groups. They hired about 7 or 8 guys at a clip, and I was in the second group that came up. Maybe it was a third. I don't remember. Anyway, I was one of the earlier groups. And so what happened was a few guys turned the corner and made it. I was one of them, and started doing well. And at the end of the first year, it was the second year technically, but the first year where anybody made money, we had been told one thing in regards to, how the scenario could play out and payments and holdbacks and all that stuff. And then when it came down to the wire, they weren't really willing to do what they said they were willing to do. And so most of the guys who made money there left. It didn't make economic sense to stay if you were a profitable trader, which, again, it's another example of a prop firm doing itself a disservice. But that was just my personal experience with that firm. Not every firm was like that by any means, but that's what happened in mine. So yeah, I was there for a year and a half, a little over. And
the skills you picked up during that experience, has that mainly shaped the way you still trade today?
Very much so. I've had to adapt. Absolutely. It was a different market back then, and you did not have the HFTs and the algos to the same extent that you have them today. They were there. I mean, it was right really when that stuff was starting to pick up, but it wasn't as fast. And so, we also had economically, there were some things driving treasury markets that were causing major spikes. So it was a very volatile market to trade. And, the speed wasn't the same in terms of how fast prices were cleared out. So you still had to anticipate, the move itself. It wasn't like you were playing for ticks, but there were times back then when I was fast enough that I could beat most people to the punch. I got that way. So as, programs came in, it got to be more where I had to anticipate way better in terms of just stepping up and firing off. But yes, not to get off topic, yes, most of what I learned while trading there pretty much shaped how I've traded since then. And that's predominantly because it was there that I learned the core fundamentals about what actually drives markets. Prior to that, I really didn't understand how large traders influence the market and, how size moves it and how guys basically look to create stop runs in certain areas, etc. I didn't know much about the spreading and the hedging and things of that nature. So yeah, I still pretty much fire like I did back then, only I've had to adapt it to a bit of a choppier market where programs are wiping out prices really fast.
So in a nutshell, you mentioned you look for size trading, stop runs. How would you summarize your overall trading strategy?
In a nutshell, I try to identify what the volatility is like. So this goes to, not to give myself a plug, but if anyone's interested, the most recent YouTube video I posted was about understanding context. And so when I talk about understanding context, and you'll hear other guys talk about this as well, I try to identify right off the bat whether or not it appears there's going to be action. And by that, I mean, are there going to be players today who step up to try and do something? Because as you know, there are plenty of days where you go in and it's just kind of a flat line. I mean, in retrospect, it looks like, if I'd only played that range, or, man, that breakout seemed like it would have been easy. But in fact, whenever it was taking place, it wasn't that easy, and that range really wasn't clearly identified. And that's because the volume wasn't moving fast. So I like to see signs that there are guys willing to play. That's why I make the poker analogy quite often in terms of, I want to sit down at a table with guys who are eager to get their money in. They want to fire. I don't care if they're raising or trying to raise me off pots or whatever. It doesn't really matter as long as they're playing the game. So, in a nutshell, try and figure out whether that's going to be good action. Sometimes you don't know until it happens, but sometimes there are clues that this might be a pretty busy day. And obviously, if you have news, usually you have some movement. And then sort of wait for spots where there appears to be the potential for a breakout, or there appears to be size supporting or defending, and then sort of fine-tune my entry to really look for those key prices where I know I should be right within a few ticks, not put myself in a situation where I have to take too much heat. Not obviously sitting in a 10-tick loss before I'm wrong. Try to pinpoint key spots, and then if it goes, it goes, And I also have a way of anticipating the most likely scenario on both ends, not just when I'm wrong, but when I'm right. So there are certainly trades that I get into, and of course, since I'm treasuries, it's not like S&P where you're sometimes looking for a 20-tick run, although you never know in the S&P either. But in the treasuries, I typically know when I'm getting into a trade if it's probably going to be a quick 3 or 4 tick pop, and I might do a quick scalp on that. Maybe I'll only get a tick or two. Versus maybe this is a trade where I can get in 3 or 4 ticks and then kind of have a free look at a farther press. And I know that before I ever get in the trade, basically, whether or not it's probably going to be a quick scalp or a longer, or has the potential to be a bigger, winner. And then monitor it at that point, kind of from tick to tick, and just wait to see what kind of pressure there is.
So once you've got your free look, do you then look for the same conditions to exit on the trades that you get that free look in? Yeah, pretty much. It's, ultimately it's just, not to sound flippant, but, ultimately it's just buy low, sell high. And so what you have to have for that to occur is one side has to overwhelm the other. So I'm looking for, when I'm entering into a trade, I'm looking for a sign that it appears, and at this moment, that's a big part of it too. Like, I don't want to put myself out there in the middle of a range and just sort of hope that a level holds. I like to see an indication that sellers are overwhelming buyers consistently, or buyers are overwhelming sellers consistently, at a certain spot. And then, yes, once I'm in a trade and it begins to move in my favor, the exit is dependent upon the same thing. Yes, are we hitting prices now where it's not falling as easily, And it's not, once you get used to watching it, it's not that hard to see. You can't ever really be sure if you're going to be exiting at the right price or the best price, but, you can see certain prices that obviously give way very easily. They run over a price with 800 contracts. They run over the next price with 900 contracts. And then they hit a price where, now 3,000 contracts trades. So it's not necessarily that you want to exit just because you see that, but obviously there are more buyers than there were at the previous two prices, right? So, maybe this is where you want to start looking for a potential exit. As long as you see them blowing through prices on pretty light volume, then you might as well hold the trade. And will you try and work for that extra tick on the exit?
I will if I don't think they're hitting a wall. Sometimes, you can tell that they're hitting a certain price or two prices, and it almost looks like they're just running into a wall. And those areas can sometimes be the spots where you get a very sharp, quick bounce or reversal. So obviously I don't want to, if say I'm in like a 7-tick winner or something in the treasuries, I don't want to give back 4 ticks. If I've caught a decent move and they've pressed it 7 ticks in my favor fairly easily, and now I see them hitting a wall, I will try to get the 7th tick, or the 6th or 7th tick, but almost guaranteed I'm taking 5 out of that trade, because I don't want to allow it to turn around, because it can happen. And it happens even easier in the equities markets. I mean, we all know that the S&P can drop off 10, 12 ticks, and all of a sudden they sort of trade 1, 2 prices, and if you don't catch that price, that it'll turn around and it'll rally 7 ticks straight back up. So you can't be too much of a, the saying, whether you use this or not, it's like, don't be a prick for a tick, right? But sometimes it's worth that, because you're pretty sure you can get the extra tick, versus other times where it seems to be pretty clear that you may or may not get it. So if I don't really know, I'll just pay up the extra tick above it and take it off.
Would you consider yourself as purely a scalper, or are you more of a short-term trader?
Yeah, to me, I mean, scalping is basically trying to find prices, going back to what I was just describing, trying to find a price or 2 prices or an area where it looks like you have somebody overwhelming somebody else. And then you can step up in that area, and you should know that you're wrong fairly quickly. That's probably the first thing about scalping, is that maybe you're not wrong long term, but short term you're probably wrong if it goes against you not very far. So that enables you to keep tighter stop limits, so you don't risk too much on trades. And then when you're in the trade, you just try and get what you can get out of it. So sometimes, sometimes a trade is only good for a tick. Sometimes, as a matter of fact, sometimes scalping ticks is the right play in a range. But other times, you try to go for 3 to 5 ticks, 6 ticks out, and then if you're really on the right side and you have momentum, maybe you'll make a 10 or 12 tick winner out of it. Again, it's obviously specific to whatever market you're trading, but I view it and define it as trying to get the best risk to reward scenarios and riding the momentum for all it's worth. And when the momentum stops, when it clearly stops, you get out, because you can always get back in. I think that's where scalpers have the advantage. Is I have no problem usually exiting, and then if I think I've exited too early, I'll just hit back in. And yeah, maybe I give up a tick or two, because it went a little bit farther in my direction. On the other hand, there are plenty of times when it doesn't go any farther. I get out the exact right price, and then it retraces 3 or 4 ticks. And then maybe I get back in, or maybe I stand aside. So yeah, scalping, discretionary scalping is not like an HFT that is just looking to capture bid-asks risk-free. I mean, that's obviously nice that you can do that, but it's not the same thing. And
you trade the treasuries. Is there a reason that you settled on the treasuries, or was it just conditioning from the prop trading days?
It's probably both. It was definitely conditioning from prop trading, because that's what we traded for the most part. There were a few guys on other desks that tried equities and tried, I think they even had a grain department at one time. But what's interesting about that is there's a reason they chose treasuries. And so this would go to the reason why I'm still with them. In a thick liquid market, that's also not a popular market. So by popular, I mean everybody in the world trades stocks. I mean, we all know that. Everybody knows about the stock market. Everybody knows about the Dow Jones. Funds predominantly invest in the stock market, one way or the other, whether it's ETFs, outright stocks, baskets, or trading the S&P futures or Dow futures. So if you're in equities, you have to understand that you have millions of people around the world, literally millions of people, I would say, executing strategies based on who knows what. And so you typically have a lot more erratic behavior, I feel. If you go to a product like Treasuries that your general populace doesn't really trade, doesn't even know there's a futures market in Treasuries, then what you find in markets like that is heavy hitters tend to dominate a little bit easier. Not all the time. They can get run over, and sometimes they can chop it around and make you wonder what you're doing, sitting in front of your screen. But markets that can be dominated a little bit easier by fewer players are actually markets which are easier to read over time, because once you understand how those players play, again, going back to the poker analogy, if you know how the guy across the table plays, you can take advantage of that over time. Maybe not on any, one particular hand, saying like maybe not one particular trade, but if you play with that guy, for 6 months every week, you're probably going to beat him if you're a better player than he is and you figure out how he plays. So with trading, we're not beating one guy across the poker table. What we're doing is trying to basically piggyback on heavy hitters and take advantage of rushes that are created by HFTs and algos. And so I think a slower, more liquid market is more conducive, at least to learning too. I mean, that's why I focus on it in my material. I mean, I do trade it, so I know it better. So it's the best route for me to go. But even from a learning perspective, I always advocate that people learn in the Treasuries or the Eurex markets. I mean, the bund and the bobble, the bund can obviously move way differently than Treasuries, but there's still a flow there in the bund and the bobble that you don't find in equities. And as a matter of fact, even the Euro stocks flows a little bit better than U.S. equities. So I'm always about trying to find that spot where you don't have to constantly be so concerned about riding through 6 ticks of chop. And there are spots in Treasuries where, I mean, if you get your price and it goes bid or offer, you've got it. I mean, you have a free look, guaranteed. And whether you let it come back on you is a discipline issue. But, you hit the price, it goes, you get a tick in the money on it. And now if you choose, worst case, that trade is a scratch. I mean, worst case scenario, you have it. Whereas in your thinner markets, sometimes the S&P, but even more so with oil or gold or something like that, you never are in that position. I mean, yeah, sometimes you hit it and it runs right away, but generally if you're in kind of an area where you're feeling it out, you have to ride through chop. You never get that edge, that free look, where worst case it's a scratch. And so that's probably the main reason why I still prefer Treasuries. They tend to flow better at times. Of course, at other times it sucks when 60,000 contracts trade at 2 prices, but you just stay out of that type of chop.
And do you ever switch markets for trading opportunities?
I mostly stay with Treasuries. I will sometimes be watching the S&P, and more so in the afternoon. I don't usually trade afternoons anyway, but if Treasuries are really dead and it feels like equities have the potential to move, sometimes I will cut over to those, but I don't trade nearly as big, I'll just trade a little bit smaller size and maybe take a shot in the S&P on a couple of trades. But I much prefer actually the Eurex markets over U.S. equities markets. So if I find myself having bouts of insomnia, I usually will boot up and trade the bund bobble a little bit, and then the Euro stocks when it comes online for like the first hour and a half sometimes.
Is that on a day-to-day basis? So say the US session is dead, and you've got a bout of insomnia, will you fire up the Eurex markets in the morning, or is it more over a week or two?
Nah, totally day-to-day basis. It's hard on where I live. I'm on the East Coast now, so in the States. So I've done periods where I've traded Eurex for, a couple weeks on end, and it really messes with my biological clock. So it's not something that I typically do on a weekly basis. I may just have some periods where I'm like, let's fire it up, and I'm good to go with it. But I do think those markets are are very good for trading. I always recommend that European traders and Asian guys in Asia, and actually guys where you are too, in Australia, look at the Eurex markets because the hours are typically better, and I think they offer opportunity. But for the most part, 97% of my trading is in treasuries.
All right. Well, on a slightly different topic, more how you manage your trades. As a purely discretionary trader, do you do the textbook probability and expectancy calculations on your trading?
Not really. Let me go on one of those quick mini rants that you were talking to me about. Have you seen, a guy forwarded this video to me recently, the Bulls and Bears, about the trader this is going back in the 90s, but he was based in Australia. A guy, a big, huge trader that was trading out of, looked like a small shack, and I think it was in Queensland somewhere. Have you seen that?
The guy in the singlet.
Yeah, I think, yeah, and he would go, like, he drove down to the Sydney Exchange for a couple of days, and the reason I mention that is because when you watch a video like that, or you watch Floored, or anything where you clearly have real traders being interviewed, what starts to come across, if you're paying attention, is that these guys have swings. And the idea of, like, I don't want to say you don't want to have an idea of positive expectancy. You do kind of have that, and you obviously, like, a large part of what I try to teach is understanding proper risk to reward scenarios. But it's so much more a long-term endeavor. And what I mean by that is when you go on runs, you may go on a run and crush it for 2 months, and then there may be a 2-month period following that where, for whatever reason, it's just not there. So what you sort of learn as you progress through this craziness is that the only thing that really matters is the bottom line, ultimately. And it's sometimes that comes across wrong, because I don't want people to think that, like, oh, well, you just go in and fire it off and see if it works or if it doesn't. But, the guy in that video in Bulls and Bears, they caught him on camera during a period where he said he lost over $1 million, and you could tell he didn't even really want to admit it. And then, like, a few months later, he went down to the exchange, and he realized that the volatility was there, and the action was there, and he said, I need to be down here on the floor. This is where it's at. And he ended up making back all that money plus more. And that's really how trading works in the real world. You do want to try to minimize drawdowns, obviously. You want to make sure that, if you get hit, you need to step aside or take a step back and assess what you're doing wrong, But from a long-term perspective, having the idea that you're going to have X percentage of winners and they'll yield a X profit of this or whatever, it's not really realistic, because there's too much on a day-to-day basis that comes into play. I mean, when the market's disintegrating, you might be short and you realize it's still going down, and you hit it again. You go up double, go up triple, and they just crush it. And on that one day alone, you end up making your entire month because, you kill it that day. So trying to funnel that into a mathematical breakdown doesn't really work.
Pretty difficult.
Yeah, it's not.
Well, it doesn't achieve, it encourages people that every day you should have a certain number of trades, I think.
Yes, I agree. I completely agree. So people get into that mindset of, well, how many trades a day should I be making? Should I be going for a certain tick number per day? Should I have a cutoff, both ways? Like, a lot of people always ask me that question. Should I have a daily goal cutoff on the positive side? On the negative side, usually, yeah. I mean, you should kind of know where, on the negative side, to approach that first, you will eventually figure out when trades just aren't working, and the chop is kind of bad, and okay, it's not a very good day, so that's why I'm down a few ticks or whatever, versus a day when you're obviously doing something stupid, You know, like there's no reason I should be down this much. And you look back over your trades. So on those days, you typically should have a cutoff when you know that you're being kind of stupid. Or you at the very least need to walk away, clear your head, come back, and then try to get back in the zone and maybe, make your money back. On the upside, a lot of people ask, well, what if I've hit my 6-tick goal, or 7-tick goal? Because they're looking at it from the viewpoint of, well, if I make 5 ticks a day at the end of the week, that's 25 ticks a week, that's 100 ticks a month, and I'm going to be rich in 2 years. And, it never works that way. So what I tell people is, if you're up 5-6 ticks, and the market's booming, don't step away just a step away. That might be a 25-tick day right there. On the other hand, if you're up maybe 10, 12 ticks, once again, adapt this to whatever market you're trading in terms of tick value. But if you're up 10 or 12 ticks and you give back half of that, then yeah, you might need to step aside, or step back and say, wait a second, has things changed? I need to drop off. But yeah, from that viewpoint, you can't go into it thinking that I'm going to make so many ticks per day or average this or whatever. It doesn't ever work that way. It's very much a long-term endeavor, and that's why there's no substitute for bankroll, and there's no substitute for being able to trade some decent size. When you're in the zone and you're killing it, you have to make enough money to make your months and your years, because there's going to be periods guaranteed where you're just not going to make anything for weeks on end, whether it be bad trading, bad market conditions, vacation, holidays, whatever.
On the daily and weekly scale, do you have a cutoff similar to how you would on an intraday time period? So you have, say, 2 consecutive losing days. Do you ever take a break from it?
Yeah. Probably not 2 days, but if I go 3 days or something where it just doesn't seem to be there, I might just call it, assuming there's not any major news. If there's a Monday, Tuesday, Wednesday, and I'm not really doing very well, but maybe I'm only down, 5, 6, 7 ticks on the week or something like that, that's not much. You can make that back on one trade. So, and if there's going to be news, like PMI or unemployment, something that's going to move the market, Michigan sentiment, I'll probably come back in on Thursday and Friday and kind of give it a shot. But if it's maybe midweek or something, if it's like I've traded all week long and it's Thursday and I'm stuck and there's no news on Friday and obviously it's just not happening. On some of those weeks I just call it and try and come back in after the weekend with a more clear head. 'Cause sometimes that's all you need. You just have to be able to go to sleep and forget about it. And wake back up and go to it again. But yeah, you do definitely need to recognize whether it's just a bad day or two in terms of volatility, or if something's wrong, whatever it may be. It's not suiting your style. It's too choppy. Maybe or subconsciously something's bugging you somewhere else in your life and you're not staying very focused. Actually a quick tip for anybody who, this is something you can probably recognize in your own trading. If you find that you come in and you sit down and, you lose 2 ticks and it's, half an hour into trading and you're ready to just turn your computer off and you're just totally not into it, it's probably a good sign that you should take a break for a while. 'Cause you have to be willing to sit, you have to be focused every day like an athlete. So you gotta be willing to come in every day, sit down at the open, and be committed to sitting there for 3-4 hours, because the market goes up and down. That's how you end up doing it. And some of my probably worst periods, not that the drawdowns are terrible, but just in terms of trading, were these periods where, I may come in and for whatever reason, I'm sitting there for half an hour and I feel like I'm just bored out of my mind and don't want to be there, and then you make a bad trade and you lose 2 ticks. And so mentally, when I recognize that, I just call it for a day or two and I wait till I know that I'm ready to wake up one morning and sit down and go full steam ahead for 4 hours.
Would you say that is part of your edge? So the days you do crush it, and since you hopefully come out on top overall, you've got certain things you look for on the market, but is a core part of your success your ability to step back and perform when necessary?
Yes, I would say so. And I would say that's true for any trader anywhere. you have to know when to step away. Knowing when not to trade is easily as important as knowing when you should trade. And it's all about preservation of capital. I mean, someone told me this a long time ago, which is, it's not how much money you make, it's how much money you keep, which is so true. And, you can, learn the hard way how true that is if you're not careful. And, so yeah, I've always been very risk averse in the monetary realm, like when it comes to business, trading, whatnot. I've never I don't step up and take shots like around unemployment and things like that. And that's why, I try to wait for something that I've seen happen before and try to wait for those edges. And if I'm not seeing it or I'm not trading well, I try to preserve my money, and wait for better areas. And it's a very, very big part of it. I mean, I can't tell you how many guys come to me or have come to me over, the years that really their only problem was they just couldn't walk away when it wasn't going in their favor. I mean, they actually had the understanding, they could read setups. They had a market that suited them, whatever it may be, and they could go in and see it and read it and kind of trade fairly well. And then when it slowed down and when there was no read there, they just wouldn't stop. And they would try to press, and then they'd slowly, give back a tick here, give back 2 ticks, give back 3. And the next thing you know, they've gone from being up 8 to being down 2. And now, of course, they're highly upset. They've just given away 10 ticks. And so now they want to get back to the 8 they lost, right? Or the 10 they lost. They want to go back to at least being up 6 or something. And instead of going from down 2 to being up 6, they go from down 2 to being down 8. And finish the day down 10 ticks instead of up 8 ticks. And repeatedly do that over and over again. And that's the only reason they're not profitable, is they just don't have the discipline to make those cutoff standpoints, and you really have to have that. It's a day-to-day battle, for most people, but if you can reach that point, you'd be surprised how quickly your bottom line improves.
When you do turn up and trading well, would you say that there's a certain, like you've just got a particular feel for the market that day? Like how much does feeling come into your trading?
I call it an acquired intuition, which I think is the most accurate description. It's very much about feel, but it's feel based on just a huge variety of things. So this is where the context aspect comes into play. When I'm talking about context, it's hard to teach context because there's no substitute for staring at your screen every day for a year. There's definitely price action that you can show people, that you can teach them, and there's certain concepts and ideas that you can teach people. And if they kind of had the mind for it, and they're kind of into game theory or they understand the game itself, they can pick up on that. But then there's this element of it that's an acquired intuition, and you're just watching the ebb and flow of the market, and yeah, you get a feel for what's happening. And I would say that plays a very large role for any discretionary trader, because you have to be able to gauge if it's conducive to taking a shot or not. I mean, is this a good spot for me to risk my money or not? I think that's another thing a lot of people don't think about. Every time you click your mouse, you're not just risking money, you're costing yourself money in terms of commissions. So, another topic we can or cannot discuss, up to you, but another reason why I trade treasuries is because they're cheaper to trade than most US products. And, another reason I recommend the Eurex products, because they're even cheaper if you're on the euro. But whenever you click your mouse, they cost you money. You have to pay the fees and you have to pay the commissions. And you're also risking money on top of that. So you need to have a really good reason to put your money at risk. I mean, it's almost equivalent to if you're going to open a franchise, a McDonald's or Subway or something, or sandwich shop, whatever it may be over there. You're not just going to sink $50,000 into a sandwich shop on a whim in a building where there's no traffic. I mean, you need to do your research and make sure you have a good location, or think you have a good location, and make sure you have the money for the marketing and blah, 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 right? So you have to have a really good reason to risk that money to try and get a return on it. Well, the same thing applies to trading. You need to have a very good reason to actually click that mouse and make that trade and put your money at risk. And that reason needs to be you've seen something that you've seen before. Something that appears to work. And the problem with trading is it's just so easy to, it's almost too easy to trade. That's really one of the main problems. It's so easy to be sitting there in front of your computer and you don't really see a good setup, but you've been sitting there for an hour and a half and nothing's happened. And you go, you know what? I'm sitting here. They're at this level. They've been holding it. I'm just going to buy it and set a 3-tick stop. And then, of course, you buy it and it goes right through you and you blow out for a 3-tick loss because it wasn't the same kind of setup as, other setups that you've seen work. So you put your money at risk on a bad trade because you're bored. And I guess that's where, staying on that feel topic, that's where that comes in. Yeah, you have to be in the zone. You have to have a feel for what's happening. And if you don't have a feel for it, you shouldn't do anything. A guy wrote me yesterday or 2 or 3 days ago, and he said, I just couldn't, it just seemed really weird to me today. I couldn't seem to get a grasp on it. I couldn't read it. So I didn't make any trades. Was that the right thing to do? And I said, yeah. I mean, if you don't read it, if you're not reading it and you don't have a good reason to put your money at risk, the right thing to do is just to stand aside. You don't have to trade every day. You don't have to make X number of trades every day. All you have to do is make money, so wait for your spots.
So even in all of your experience, can you ever just sit down and recognize a good discretionary trade signal straight away, or do you need time to get in the flow of the market?
That varies. No, I would say that, there are times when I can be sitting there and right off the bat, off the open, I see something. But the confirmation part is what takes a little bit longer. So sometimes you see the setup and you're pretty sure you can hit a price and get an edge. Maybe get a free look, but then you have to feel it out. And so there are definitely days where I may end up hitting 2 or 3 trades that I think are good trades and I can't get paid on them. And so if I hit 2 or 3 and I can't get paid on the trades, then that is sort of a confirmation that today is probably not going to be a good day for trading, for me anyway. It seems to be too choppy or whatever. So yeah, I think it's a combination of, I think you can sit down pretty much in almost any market if you're familiar with order flow and get a feel for particular price action that seems to be working. But then it does take a little time to figure out whether or not today is going to be a decent day. But a lot of that's just, you have to feel it out as it happens. There's no way to really be able to anticipate that. Cause you just never know. I've seen the market, rally 25 ticks and then stop and trade in 2-tick range for the next 2 hours. It doesn't seem like that would ever happen, but it does. It doesn't make much sense, but it happens. So all you can do is react to it.
You just mentioned recognizing order flow, and you were to me it seems you're one of the renegades of order flow trading for the retail trading world. You kind of got it out there for retail traders. How would you define order flow nowadays? Because there's a lot of people defining it in forums and workshops now, but how does the original order flow definer define it?
Thanks for that, by the way. It is weird. It is a little weird, I have to say, man, because I know I've known you for a while now. I think you're from way back in the day. When I first built my website, I couldn't find anything even remotely close to what I was talking about out there online. It's pretty amazing how far it's come in just particularly the last like 3 years, I would say. And I think a large part of that is due to better platforms like the Jigsaw. Like when people actually see it, because most people who early on came to me, they had never seen XTrader. And XTrader, was worlds apart from every other depth of market. So that was a big enlightening part for me too, obviously. And I'll answer your question, but just as like kind of a follow up to that. If you don't see the order flow, you don't understand why it's important. That's where I'm going with this. So I had a lot of people come to me, in the beginning, and they were on some not very good depth and sales platform, or depth of market platform, or no depth of market platform. They were totally on an inside market platform. And then they would watch me on XTrader for one day, and they would say, oh, okay, this makes way more sense now, because I actually see the flow. And I'm like, yeah, that's what I'm trying to tell people. And I think, like the Jigsaw platform has even increased that tremendously. It just makes it so much easier for me to teach. Really great platform. But anyway, I would define order flow as simply understanding that the game you're playing is nothing but a big giant auction. And so you have buyers and you have sellers. Predominantly, most of them are not taking, open interest positions. You know, they're not going to take delivery. The guys playing in the S&P aren't, well, S&P is different, but I mean, different market. You know, most of your guys in the corn market, let's say, they're not going to take delivery of 5,000 bushels of corn. You know what I mean? They're speculators. So order flow is understanding that you have people around the world who are buying and selling, and they're doing so in hopes of making money for basically doing nothing but sitting in front of a computer in their pajamas. And buyers try to beat up sellers, and sellers try to beat up buyers. And big money moves the market, whether it's one guy dropping 20,000 contracts in the 10-year, or whether it's, 1,000 guys dropping 20 contracts all at one time. One side has to overwhelm the other. So order flow is recognizing through the prints, basically through your actual time and sales, your volume, at price, when it appears that one side's winning the battle. And when it appears that one side's winning the battle, you just go with that side. And when it appears they're no longer winning the battle, you get out. I mean, it's really that simple. And you don't need anything but access to volume to be able to see that. I mean, sure, you can have levels that people are watching, you support levels, resistance levels, trend lines, you can look at whatever you want to look at. That's all fine and dandy. But when it actually gets to that area, the key is, okay, is the price bouncing or not bouncing, or going down or going up, and how much size is trading at each price? And that's pretty much all there is to it. I mean, it's identifying volume and making judgments based on the volume, but it's not just volume at these prices. It's kind of having an overall understanding of what's happening. Is this real fundamental buying? Are there institutions coming in? Does it have the feel that you have institutions coming in because they're adjusting core positions, and those are the days when we see one-way streets, basically? Or are we watching a wave of speculators try to trigger stop orders, and then they're going to liquidate into those stop orders? So just having a feel for the overall big picture based on the volume, and then going down to the ultra short term small picture, which is like from price to price and what the volume's doing from price to price. I don't know how well that explained it, but that's kind of how I would define it, I guess.
Oh, it's got a much bigger context than just bids and offers.
Oh yeah. It's definitely, there's definitely information to be had in bids and offers, but I always tell people, because I get questions about spoofing a lot, and sometimes, I really enjoy seeing spoofing because spoofing gives away information sometimes. But the real core, fundamental, critical information is in the actual volume at price currently. How much is really trading at these prices, and what's the price doing as a result of that? And then, of course, you take that into the context of kind of the overall, what's the market been doing up to this point today, and how would this play into that? this market's been going one way all day and buyers are just continuing to pound it. I mean, why sell it? I mean, it may not go up much farther. It may not go up much at all, but why put yourself on the wrong side? Versus a different day, market's been in a bit of a range. This is kind of a level, it might play for a small breakout. What's the volume doing right here at this level? Is it showing any indication of running the range or guys just going back and forth, And so you adapt to the volume from a big picture all the way down to the volume at a very small picture. And bids and offers can play a role in my entry price for sure, but it's more about the actual volume trading at that price.
And you mentioned earlier that there's no substitute for screen time. So what about for traders starting out? Like, how do they get a feel for the order flow? Do they need to spend a year staring at the DOM?
Well,
I mean, obviously, tough question, but obviously one of the quicker ways is to.
I was about to plug myself. If you're a new trader and you sort of seem to realize the benefits, or at least have something of an idea that, okay, head and shoulders don't make any sense. Okay, like if you look at a chart and you look at a pattern and then you understand what you're looking at just bars on a screen that change depending upon the scale of that screen. You begin to realize sort of some of the fallacies involved with various aspects of technical analysis. So if you're a newer trader and you kind of understand the auction market and you begin to see why order flow could be helpful, there are guys, very few, but the few out there, like myself, and Peter, who can show you the game at a much deeper level. Now, the caveat that comes with that is that you're not going to start printing money tomorrow. I mean, there's no doubt about that. So what I tell people is if you're really committed, I can help shorten the learning curve. That's what guys like me do. We can show you the game. I can explain to you why certain things tend to work more often than not. I always try to show in real time or real time examples, obviously. I mean, real trades. I've clearly had my cases where I've been run over with people watching, and that's never fun. It is just part of it, though. Because it's not a guaranteed science. It's an art form. But what I do, and this is what happened to me in the prop firm, I saw somebody else making money and I realized he had a certain feel for something I didn't have a feel for. So it all began to click. So once it clicks, then you still have to sit there. And the general rule of thumb is that most people don't really turn the corner for 6 months to a year. Some people do quicker, and there are a couple of guys that hit me up and they're like, I can't believe how much I learned in 2 weeks and I'm making money, but I never know how they progress. They still run into, like, a guy may hit me up and say, hey man, I'm doing great. I made a ton of money the last 3 weeks. I'm like, awesome, and I'm happy for him. But I also know that he's going to have his own periods where something's going to happen and he's going to hit bad volatility and he's going to have a drawdown. He's going to forget about rollover. I mean, I had people writing me for the last 2 weeks, like, what's going on in the treasuries? Why is the volume so low? And I said, it's rollover, man. And it's little things like that people have to experience for themselves to get a better feel for what's going on. And so for a newer trader, I don't really sugarcoat it. I think you know that. You have to be extremely committed to this, and you can't really bank on making a living from it, usually in less than a year. You might, depending on what your bankroll is. That plays a large part. It's just it's too hard to say because there are some guys out there who have money and they can put $50,000 in an account and they can sit there every day and, they're probably going to learn a lot faster, because they're able to sit there every day and they have some money. And when they do make money, they make a decent amount. And then you have other guys who have no money. They're trying to find a job at a prop firm, or maybe they have $3,000 or $4,000 that they can put in an account. and they want to make it, and they can. It can be done, but it's a lot harder, and it's because they're just sort of at a disadvantage right off the bat, in terms of they're maybe having to work a real job. They can't trade every day. They don't have very much capital, etc. But to really get a solid feel, you need to be able just to lock down for at least 6 months, and just every single day sit in front of your screen. And if you can't do that, fortunately these days, we have recordings. So if you can't get away from your real job, or you don't want to take the plunge, my advice is usually to record a day's action, or use something like Ninja Replay, and just at least try and scan through it, for an hour or hour and a half a day. And even doing that, it's not the same as sitting there minute by minute, but you'll get a feel for it, and you'll probably learn a lot faster. It's going to be more helpful to you than just sporadically trading. You're better off actually recording 2 weeks worth of movement and studying that movement than you are trading 2 days a week. Just kind of going in when you can and then coming out, because you totally lose feel for what happened on those other 3 days. And quite frequently, whatever happened on those other 3 days has an influence on what happened the 2 days that you were trading. So I always say to one guy that I've known for a while, he's like, dude, you're depressing people. And I'm like, well, I'm not trying to be depressing. I'm the first guy to tell you. I started where everybody else did. I started with nothing, and banged away and finally managed to land a job somewhere, or a couple jobs, and then landed a good job, and I figured it out. So, it can be done. I'm the first one to tell you, anybody can do it if you have the persistence and the mind for it. You should just be realistic about it, so that going into it, so you also don't get heavily discouraged too. It's like it's kind of like anything. It's like riding a bike. When you ride a bike, you're going to fall down. That's all there is to it. So you put a kid on a bike and you turn him loose and he falls down and he busts his rear end, and then he tries, and then you go over there and you say, suck it up, get back on the bike and go again, and, that's just part of trading. It's the same thing happens. Some, guy comes to me and is like, I had a terrible day. I'm like, yeah, it happens, dude. I don't know what to tell you. Just don't, the difference is don't let it get out of hand. That's the problem with trading, is that you can go broke in a day. I write that and I kind of joke about it, but it is 100% true. You can absolutely go broke in a day trading if you completely lose your mind. So you have to have some wiring in your brain that prevents you from doing that. But aside from that, you're gonna take falls, and you're gonna have drawdowns. So just be realistic about it, and understand that ultimately the goal is not that you're gonna make X dollars per day, but that you're gonna get to the point where you can swing 10, 20, 30 contracts at a clip, and when you hit it, and when you don't, you can stand aside, and that's kind of what it's all about.
Well, that sounds like a good ending to finish up on. So,
all right,
definitely want to thank you, John, from No BS DayTrading for joining us today.
Graham, I appreciate the invite, man, and we can do it again sometime. No, I can usually talk a long time, but that'll make for a good wrap up.
You can learn more from John by visiting nobsdaytrading.com, and definitely check out his YouTube channel for some recordings and commentary on market action as viewed in the order book. For faster reactions and increased market comprehension, try adding another dimension to the order book when trading with Price Squawk. You can now listen to price and volume action for bringing the order flow to new levels of attention using sound. There is a free trial available, and we are very close to releasing our standalone audio market platform, and this will support IQ Feed, CQG Client and TT Fix, so please check it out at pricesquawk.com.